Have you ever had a trading strategy that felt like a total rock star one year, and then the next year it just completely flops,
Oh, yeah.
and you're left scratching your head, right?
It's incredibly common and frustrating.
It really is. And it often boils down to, well, one critical blind spot. The market isn't just this single predictable thing.
Exactly. It has different moods, you could say, different regimes.
Regimes, right. And these regimes fundamentally change what strategies actually work. So today we're diving deep into exactly that, how to read those moods, adapt your game.
And make sure you're not, trying to surf when there's no wave.
Precisely. We're talking about market regimes in swing trading. So the prevailing state of the market.
Yeah, like, is it clearly trending up or down, or is it just stuck chopping sideways?
Or is volatility through the roof, or is it really quiet?
And what are the bigger economic forces doing in the background?
For swing traders, figuring this stuff out isn't just helpful. It's absolutely essential for survival, really, and for success.
What's fascinating here is that without understanding these underlying regimes, you're essentially, well, you're kind of gambling, aren't you?
Right. You might have the perfect trend following strategy.
But the market's stuck in a tight range. Or you're trying to buy dips when actually a really sharp downtrend is picking up speed.
It's like trying to navigate a dense fog with a map meant for a sunny day. It just doesn't work.
Being in sync with the market's current state is, yeah, it's truly crucial for aligning your approach and, frankly, significantly improving your odds.
And that really underscores why so many strategies seem to just fail when the market shifts its personality. So, for our deep dive today, our mission for you, the listener, is to pull out the most important insights from our sources on how experienced traders identify these market moods.
How they adapt their strategies, how they tweak their day-to-day tactics.
And even how they factor in their own personal situation, time constraints, risk tolerance, things like that.
Think of this as your shortcut, your condensed guide to getting really well-informed on this essential part of trading.
Okay, let's start making sense of the market's shifting personality.
Sounds good.
So we're talking about market moods, which, okay, sounds a bit abstract. But how do traders actually see these moods in practice? What are the signs we should be looking for?
Yeah, that's the million-dollar question, isn't it? It's rarely one big flashing light. It's more subtle.
Okay.
Smart traders tend to use several different lenses, kind of building a picture from a collection of clues. And one of the most fundamental is simply asking, is the market actually going somewhere, or is it just stuck?
Right. So that's our trending versus choppy lens.
Exactly. A trending market shows clear directional movement, higher highs and higher lows in a bull market or lower highs and lows in a bear. That's where trend-following strategies just, well, they thrive.
Makes sense.
But then you get these sideways or range-bound markets where prices just bounce around between support and resistance, not really making any headway.
And those sideways markets can be incredibly frustrating if you're geared up for a big trend.
Oh, absolutely. They chew up trend followers. So these choppy periods, they need a different playbook entirely. Mean reversion trades.
Buying low, selling high within the range.
Exactly. Buying near support, selling near resistance. Those tend to work best. And you also have to be really wary of false breakouts.
Yeah, where it looks like it's breaking out, but then wham, back inside.
Precisely. Now, for identifying this practically, traders often use something called the Average Directional Index, or ADX. Think of it as a trend strength meter.
Okay.
Generally, if the ADX is below, say, 20, it signals choppy conditions. If it's above 25, you're likely in a trending market.
Got it.
But here's a key insight. It's not just the level, it's the direction. A rising ADX, even if it's still low, suggests a trend is starting to form.
Interesting. An early heads up.
Exactly. And conversely, a high ADX that starts to fall can be a critical early warning that a trend is losing steam, even if prices are still technically moving.
That's a great point, looking at the change in the indicator, not just the static number. Okay, so we've got direction versus chop. What about volatility? The size and speed of the swings?
Yeah, volatility is another huge lens. It drastically alters your tactics. You've got high volatility environments, sharp, frequent swings. Maybe the VIX, the fear index, is above 25 or so.
Hey, things feel wild.
And then you have low volatility periods, milder, more orderly moves, perhaps VIX below 15, calm seas.
So how do traders adjust?
Well, in high volatility, experienced traders often use smaller position sizes to manage the increased risk. They'll use tighter stop losses, maybe have shorter holding periods. Mean reversion strategies can work well here too because those wild swings often snap back.
Okay.
In low volatility, you might use slightly wider stops, maybe slightly larger positions carefully, of course, and if you're trend following, you might let winners run longer.
And is there an indicator for this, like ADX for trend?
Yeah, the average true range, or APR, is a common one. Unlike ADX, it's non-directional. It just measures the typical size of the daily price range.
So how wide the swings are.
Exactly. Rising ATR means wider daily swings, more turbulence. Falling ATR means tighter ranges, calmer seas. Traders use ATR dynamically for risk management, like setting stop losses at, say, 1.0 or 2.0 times the ATR below their entry.
That makes sense. Adapting risk to the current conditions.
Fortune favors the prepared, right?
Okay.
You need to adjust your sails to the wind.
Okay, so we've covered direction and volatility, but what about the conviction behind the moves? Sometimes a market rallies, but it just feels fragile, you know?
You've hit on a crucial point there. That's where understanding market breadth and leadership comes in.
Breadth. Like how many stocks are participating.
Exactly. It's about the internal market health. When many stocks are advancing together, that's broad breadth. It signals strength, like a healthy ecosystem supporting the move.
Okay.
But when a rally is concentrated in just a few big names, what we've sometimes called narrow leadership, like the Magnificent Seven, driving things in mid-2023, that can be a huge warning sign. It suggests fragility.
Right. It's like the whole market's leaning on just a few pillars.
Precisely. And narrow breadth often precedes reversals.
Huh.
Because if only a few stocks are pulling the weight, what happens when they stumble?
The whole thing can fall apart quickly.
Yeah.
So how do traders measure this breadth?
They use tools called breadth oscillators. Things like the advanced decline line, which tracks the net number of advancing versus declining stocks, or the McClellan oscillator. They essentially measure the collective health.
Like checking if the whole fleet is moving or just one big ship.
That's a great analogy. And crucially, watch for divergences. If the main index, like the S&P 500, makes a new high, but the AD line doesn't confirm it, that's often an early warning that the regime might be shifting.
Got it. Divergence is a red flag. Now, zooming out even further, how do the big macro factors fit in? Central banks, interest rates, liquidity. Surely that sets the overall tone.
Oh, absolutely. Let's connect this to the bigger picture, liquidity and the macro tone. Think of liquidity as the fuel for the market.
Okay.
When capital is cheap, abundant, flowing freely, that's your loose liquidity environment. Low rates, maybe quantitative easing. Think of the 2010s post-financial crisis.
Right, when growth stocks really took off.
Exactly. Because as one analyst put it, when capital is cheap, investors invest in the future. It fuels risk-taking and growth stories.
Makes sense.
But when central banks hit the brakes, raise rates, pull liquidity out, that's a tight liquidity regime, money gets expensive.
Like we saw more recently.
Precisely.
Yeah.
The cost of capital rises, risk appetite shrinks, you often get higher volatility, and leadership tends to shift towards defensive stocks or value stocks, companies making money now.
So traders are watching interest rate trends, yield curves, Fed statements.
All of that. To understand if the macro wind is at their back or in their face, it sets the stage for everything else.
Okay, so we've identified these different market moods, trend, volatility, breadth, liquidity. But the big question for a swing trader is, so what? How does knowing this actually change what you do day to day? Because using the wrong strategy at the wrong time, well, that's just a recipe for disaster.
Yeah.
This is where it gets really interesting, aligning specific strategies with these conditions. Let's start with momentum.
Okay, momentum trading. It's all about buying strength, jumping on board stocks that are already moving strongly in one direction.
Riding the wave.
Exactly.
Yeah.
And it absolutely thrives in clearly trending markets, especially when breadth is broad and liquidity is easy. Think about those big growth stock surges in 2020, 2021. That was prime momentum territory. You want that rising ADX confirming the trend.
So when does it not work?
Well, momentum really struggles in sideways or mean reverting conditions. Those breakouts you're trying to buy just fail and you get whipsawed back and forth.
Painful.
Very. And in high volatility regimes without a clear direction, forget about it. It's a nightmare. Momentum swing trading is genuinely like surfing.
Yeah.
You absolutely need a good, solid wave, a steady trending market with lots of stocks participating. Otherwise, you're just going to get tossed around in the chop.
Okay, clear enough. So on the flip side, what about mean reversion strategies?
Right. Mean reversion is the opposite logic. You're betting on short-term reversals of moves that have gone too far too fast, looking for things that are stretched, overbought, or oversold, and due for a snapback.
Buying dips and selling rips?
Basically, yes. And these strategies thrive in sideways or range-bound regimes where prices just bounce between support and resistance. You mentioned 2015, 2016 earlier. That was often a good environment for it.
Okay. Does volatility play a role here?
It can. High volatility conditions, say VIX above 25, can also favor mean reversion. Why? Because those extreme emotional swings, panic selling, euphoric buying, often create deviations that snap back pretty quickly as things calm down.
Ah, I see. But when does mean reversion fail?
It fails spectacularly in strongly trending markets if you're trying to buy the dip in a relentless bear trend.
You're catching a falling knife.
Exactly. Or shorting rips in a powerful bull market. You'll get run over. So the more the market acts like a pendulum, swinging around some middle ground, the better for mean reversion. The more it acts like a rocket, the worse.
Got it. Pendulum good, rocket bad for mean reversion. What about event-driven strategies, focusing on things like earnings reports?
Yeah, catalyst trading. How these play out is also very regime dependent. In a bullish, low volatility market, good news in rearn, a great earnings report, say, often produces an outsized, sustained move higher.
People are willing to chase the good news.
Right. Traders might hold through the news, expecting follow-through, but in a bearish or highly volatile regime, even good news might only lead to a very short-lived pop that quickly fades. And bad news, that can trigger really exaggerated drops.
So traders have to adapt how they play the news.
Absolutely. They adjust position size, maybe shorten their time horizon. In easy markets, they might try to ride the news for a multi-day swing. In turbulent markets, they might be more inclined to fade the news, sell into the initial strength after good news, or buy the washout after bad news because that follow-through is just much less likely and the risk is higher.
Okay, that makes sense. Finally, what about rotation strategies, shifting between sectors or styles?
Right. Rotation involves trying to always be positioned in whatever part of the market is currently performing best, shifting from tech to energy or growth to value, for instance.
When does that work well?
This kind of strategy thrives in moderately trending or cycling markets. It's especially useful when market breadth is narrow, meaning only specific pockets of the market are working, and you need to be in those pockets.
And when does rotation struggle?
It struggles in those all-or-nothing environments, like a super strong bull market where everything is going up. Rotation might just add transaction costs. Or a sharp bear market where everything is falling, there's nowhere safe to rotate to, except maybe cash.
So it's best for more normal conditions.
Yeah, exactly.
Yeah.
Normal variable conditions, where leadership is constantly ebbing and flowing. Use relative strength analysis to guide you, trying to stay aligned with where the big money is flowing. It's about being in the right place at the right time.
Okay, so we know which strategies fit which regimes. Now let's get tactical. What does this mean for the day-to-day stuff? How do swing traders actually adjust their execution based on the regime? It's about adapting the actual mechanics, right?
Precisely. Your operational approach has to change. First, just think about your level of activity. Participation versus patience.
Okay.
In strong bull markets, low volatility, clear trends, traders often ramp up participation. They see more valid setups, they take more trades.
Step on the gas.
Right. But in choppy, uncertain, or highly volatile regimes, seasoned traders often do the opposite. They trade less. They sit on their hands more, waiting patiently for only the absolute A-plus setups. Knowing when to be aggressive versus defensive is critical for preserving capital.
And I assume that ties directly into position sizing and risk management.
Absolutely.
Yeah.
In high volatility or high uncertainty, prudence dictates cutting down position sizes. Maybe tighten your stops too. If you normally risk, say, 1% of your capital per trade.
You might cut that to 0.5%.
Or even less, yeah. In calmer, more predictable times, you can scale up modestly, always staying within your overall risk framework, of course. Think of risk like a dial. You turn it down in dangerous conditions and maybe edge it up slightly in benign ones.
What about how long you hold trades? Does that change?
Significantly. Trade duration is very regime dependent. In a steady trending regime, the mantra is often, let your winners run. You might hold a winning swing trade for several weeks to capture a larger portion of the move.
Okay.
But in a choppy, range-bound, or highly volatile regime, it's often short and sweet. Trades might only be held for a few days. You get in, you grab a quick profit, and you get out at the first sign of trouble, because those gains can evaporate incredibly quickly. Expected hold time definitely shrinks as volatility or uncertainty picks up.
And your profit-taking strategy must change too.
Totally. In bullish trending regimes, swing traders might aim for larger reward-to-risk ratios, maybe using trailing stops to let profits run while protecting gains.
Aiming for home runs.
Kinda, yeah. But in choppy or bearish regimes, it's more about shooting for singles, taking profits much more aggressively, perhaps at predefined targets, before the market has a chance to take them back. There's that old saying, in a bad tape, never let a green trade turn red.
That makes a lot of sense, protecting what you have when things are tough.
It's about recognizing when the risk of holding a winning position starts to outweigh the potential for further gain, especially when the market feels erratic.
And I guess hand in hand with profit-taking is your stop-loss approach.
Exactly. Needs to adapt too. Wider stops might be appropriate in smoothly trending, low volatility markets to allow for normal ebb and flow without getting shaken out prematurely.
Give it room to breathe.
Right. But in volatile or range-bound regimes, tighter stops are usually essential, maybe moving your stop to break even much more quickly once a trade moves in your favor. Your risk management rules can't be rigid. They have to be flexible.
Okay, one more tactical adaptation. The watch list itself. Does what you're trading change?
Absolutely. Your watch list composition should rotate with the regime. In a risk-on bull market, with low rates maybe, your watch list will likely be full of high beta stocks, growth names, momentum leaders.
Exciting stuff.
Yeah. But in a defensive, uncertain, or bearish market, your focus might shift dramatically. You might tilt towards lower beta, more resilient stocks, utilities, consumer staples, or even start looking for potential short candidates if the trend is down.
So your opportunity set changes.
Completely. Your watch list has to reflect where the market is showing strength or weakness now. Think about 2021 versus 2022. A trader might have gone from watching 30 high-flying growth stocks, taking 4 or 5 swings at a time, risking 1%, holding for weeks in 2021.
To maybe watching a dozen defensive or value names, taking only 1 or 2 quick trades, risking 0.5%, and holding for just 3-5 days in the volatile bear market of 2022.
It's a completely different game dictated by the regime.
That really paints a clear picture of the tactical shifts. Now, you mentioned rotation earlier. Let's dive a bit deeper into that. Beyond individual stocks, regimes drive these big picture rotations between whole sectors and investment styles, right?
They absolutely do. And this is where larger funds and institutions often shift their big allocations, creating powerful currents that swing traders can try to ride.
Okay, what are some classic rotations?
Well, 2 of the biggest are growth versus value and cyclicals versus defensive.
Let's start with growth versus value.
Sure. Growth stocks think innovative tech companies, high PE ratios, focused on future potential. They tend to shine when inflation and interest rates are low and liquidity is abundant, like much of the 2010s.
Because cheap money fuels investment in future growth.
Exactly. When capital is cheap, investors invest in the future. But when inflation picks up and interest rates rise, that dynamic flips. Higher rates make those distant future earnings less valuable today. Investors start demanding returns now.
And that favors value stocks.
Generally, yes. Value stocks, often in sectors like financials, energy, industrials, with lower PE ratios, maybe paying dividends, tend to outperform when rates are rising. So the key question becomes, is the market rewarding future potential or current profitability?
And traders watch macro clues for this. Bond yields, Fed policy.
Yes, alongside relative strength charts comparing growth ETFs to value ETFs, for example. If bond yields are breaking higher, suggesting rising rates, a trader might start rotating away from growth and towards value, anticipating that capital flow.
Okay, what about cyclicals versus defensives?
Similar logic, but tied more to the economic cycle. Cyclical stocks think autos, airlines, construction, industrials. Their fortunes are closely tied to economic growth. They do well during expansions.
And defensives?
Defenses, utilities, healthcare, consumer staples are less sensitive to the economy. People still need electricity, medicine, and toothpaste even in recession, so they tend to hold up better or even outperform during economic downturns or periods of uncertainty.
So traders increase cyclical exposure when the economy looks strong.
And they shift towards defensives when storm clouds are gathering. Exactly. We saw a clear example in late 2022. As recession fears mounted globally, money flowed out of cyclical sectors and into defensive ones, like certain consumer goods companies in markets like India, for instance.
And these rotations can happen together, right? Like a shift to value and defenses.
Oh, definitely. They're often intertwined. Think about 2022 again. The Fed was tightening aggressively. That led to higher volatility, a clear downtrend in the indexes, and it simultaneously favored value over growth and defensives over cyclicals. You also see rotations between small cap and large cap stocks driven by similar forces.
So rotating effectively is about what? Being aware of these bigger flows?
It's about being in the right place at the right time. recognizing which styles and sectors are currently favored by the prevailing economic and liquidity regime and aligning your trades with those broader money flows. It's about swimming with the current, not against it.
Okay, we've covered a tremendous amount about the market's moods and how strategies and tactics need to adapt. But there's one more crucial layer, isn't there? It's not just the market, it's you.
Yes, the personal factor. Hugely important.
Your personal profile significantly overlays all this regime adaptation stuff. Because, let's face it, a theoretically perfect plan is completely useless if you can't actually execute it consistently.
So true. Take, for instance, just your available time. If you have a demanding full-time job, limited screen time.
You're not going to be day trading complex volatility strategies.
Exactly. You'll naturally gravitate towards slower swing strategies, maybe using end-of-day data, focusing on daily or even weekly charts. You need an approach that fits your lifestyle, avoiding those rapid intraday decisions that just aren't feasible for you.
And what about personality? Risk tolerance, comfort with drawdowns?
Absolutely critical. Some traders can psychologically handle larger swings in their account equity, bigger drawdowns better than others.
Right.
If you have a low tolerance for drawdowns, you might favor strategies with higher win rates but smaller average profits, like perhaps certain mean reversion approaches, to keep those equity curve dips minimal.
Smooths the ride.
Exactly. Whereas someone with a higher tolerance might be comfortable pursuing more aggressive momentum strategies that can have deeper pullbacks but potentially larger payoffs. The key is matching the strategy's inherent risk profile to your psychological risk profile.
So you can actually stick with it through thick and thin.
Precisely. You need to be able to execute it consistently without getting emotionally derailed when things inevitably get tough.
And then there's just complexity versus simplicity.
Yeah. Some people love intricate multi-system approaches. They enjoy juggling lots of indicators and complex rules. Others thrive on simplicity. Maybe one core strategy that they just scale up or down, or apply more or less frequently, depending on the regime.
There's no single right way.
Not at all. It's about finding what aligns with who you are, what feels manageable and sustainable for you. Because ultimately, a plan is only effective if you can actually execute it consistently over the long haul. The best plan is the one you can stick to.
Okay, let's really bring this home now with some real-world examples. How did traders adapt or fail to adapt across different contrasting market periods?
Great idea. Case studies make it tangible. Let's look at Trader A, navigating the shift from late 2019 into the 2020 COVID crash.
Okay, what happened?
Well, in late 2019, the market was in a relatively calm, steady uptrend, low volatility. Trader A was doing well with standard momentum breakout strategies, holding multiple positions, letting winners run. Pretty standard bull market play.
Right. Then March 2020 hit.
Exactly. Suddenly, unprecedented volatility, indexes plunging daily. The regime shifted violently. Trader A recognized this instantly. They didn't try to keep playing the old game. They quickly unwound most long positions, went heavily into cash.
Full defense mode.
Absolutely. During that intense volatility storm, they didn't try to be a hero. They maybe took a few very selective, small-sized mean reversion trades, quick scalps on bounces with extremely tight stops. The primary goal was capital preservation.
Survive the storm.
Precisely. And because they protected their capital, when the market started a bottom fueled by massive central bank stimulus creating a new liquidity regime, they were ready. They pivoted back to offense, identified the new emerging leaders, particularly in tech and pharma, and started scaling back into momentum trades aligned with the new bull trend.
Wow. So offense to full defense, then back to offense, adapting to each regime shift.
It's a perfect example. As one trader wisely put it, if you protected your boat in the storm, the wind that came after blew you swiftly forward. They survived the chaos and were capitalized to ride the next wave.
Okay, case study 2. Navigating the high inflation bear market of 2022. How did someone adapt there? Let's call them Trader B.
Right, 2022 was tough. Rising rates, high inflation, tightening liquidity, a completely different regime from 2021. Trader B realized their previous growth momentum strategy was just getting crushed. Breakouts were failing constantly.
So what did they do?
They recognized the macro shift was favoring different areas. They rotated heavily away from growth stocks and towards value and cyclical sectors that were suddenly showing relative strength. Think energy, metals, some industrials.
Following the money.
Exactly. They also incorporated a short bias into their trading, something they hadn't done much before, to play the downtrend. And, crucially, they adapted tactics. Significantly reduced position sizes, took profits much quicker because volatility was high and bounces were short-lived.
And they watched breadth.
constantly. They recognized that many of the rallies were very narrow and likely unsustainable, using that as a signal to be cautious or even take profits. By rotating sectors and adjusting their risk and timing, they managed to navigate a difficult down market much better than if they'd stuck to their old playbook.
Shows the power of recognizing that macro shift and adapting.
Okay, how about a range-bound market? Let's say Trader C in 2014.
Yeah, 2014 was interesting. The overall S&P 500 index didn't trend very strongly for parts of the year. It was quite range-bound overall. But within the market, there was active sector rotation. Leadership was shifting around quite a bit.
So not a strong trend, but internal movement.
Exactly. So Trader C couldn't rely purely on trend following the index. Instead, they adopted a two-pronged approach. First, mean reversion, trading support and resistance levels within the established ranges of various sectors or stocks.
Buying dips, selling rips within the range.
Right. And second, they actively employed sector rotation. Using relative strength, they shifted capital between sectors as leadership changed, maybe moving from healthcare and utilities, which were strong early, into tech or cyclicals later when they picked up.
So combining mean reversion with rotation. Yes. And critically, they kept trade durations relatively short and updated their watch list constantly to reflect these shifting mini regimes within the broader range. It shows how you can still grind out profits, as they say, even without a major market trend, by being adaptable and aware of internal dynamics.
Fascinating. One last case. Reacting to narrow leadership like Trader D in early 2023.
Ah, yes. Early 2023 saw the S&P 500 rally, but as we discussed, the breadth was historically narrow. It was overwhelmingly driven by just a handful of mega-cap tech stocks, the Magnificent Seven.
Right. Everyone was talking about it.
So Trader D was participating, maybe bullish on those specific leaders, but they were also keenly aware of the deteriorating breadth in the rest of the market. They saw it as a major warning sign, indicating the rally's foundation was weak.
So they didn't just blindly follow the index higher.
No, they used that breadth signal. They started tightening stop losses on their winning positions in the leaders. They became much more selective about adding new trades, especially avoiding stocks in lagging sectors. They recognized the fragility.
Preparing for a potential stumble.
Exactly. And when those leaders finally did start to falter around August 2023, Trader D wasn't caught completely off guard. They'd already trimmed exposure, protected some gains, and were likely already rotating towards more defensive areas. It underscores using regime filters like breadth and leadership to know when a trend is becoming suspect, even if the headline index looks okay, and avoiding overstaying your welcome.
Those are fantastic examples of adaptation in action. So to wrap this all up, it seems clear that swing trading isn't some static set-it-and-forget-it pursuit. It's fundamentally an adaptive game.
It really is. It's this constant blend of understanding the market's current regime, the trend, the volatility, the breadth, the liquidity backdrop.
Combining that with flexible strategies, adjusting your tactics dynamically.
And crucially, making sure it all aligns with your own personal profile, your time, your risk tolerance, your personality.
That's really the core lesson, isn't it? Those who survive and thrive in trading over the long run are the ones who stay in sync with what works when.
Exactly. As the market's mood inevitably shifts, they shift with it. They knew when to play offense, when to play defense, how to protect capital, and how to position themselves for the opportunities that each new regime presents. It's about being prepared.
So as you, our listener, step away from this deep dive, maybe take a moment to consider, what mood do you think the market is in right now? Look at the trend, the volatility, the breadth, the macro picture.
And then ask, how might your personal profile, your time, your risk, comfort, best adapt to this specific environment?
How does recognizing the market's ever-changing seasons, its different moods, change how you look at potential opportunities and, just as importantly, potential risks?
Some powerful questions to reflect on.
Absolutely. That's all for this deep dive. Thanks for tuning in, and we'll catch you next time.